Welcome to a new e-learning paradigm, AplusMap.ai.
Today, we're taking a plunge into production costs and economics.
Right.
It might sound a little dry, maybe,
Yeah, possibly.
but I promise you, this isn't just textbook stuff. It's actually incredibly practical, really fundamental for understanding, how businesses work.
Mm-hmm.
And yeah, it's a massive building block for anyone tackling advanced econ, especially the AP exam. These concepts are really foundational there. So our mission today is pretty straightforward. We're taking your notes, your sources, which look great, by the way, really clear. And we're going to distill the key insights.
Make it click.
Exactly. Help these sometimes complex ideas just slot into place.
Yeah.
Think of us as your guides through this part of the economic landscape today.
And that's what we'll do. Because understanding these costs, it's not just about formulas, right?
Yeah.
It's about the logic behind actual business decisions,
Right.
whether it's a tiny bakery or some huge corporation.
Yeah.
And like you said, these pop up constantly on this AP exam. So getting a solid handle on this, it's genuinely key. Let's make sure these ideas really stick with you.
Okay, so let's start right at the beginning. How does anything get made? Economists call it the production function.
That's technical.
It does sound a bit technical, yeah. But really, it's just describing the maximum amount of stuff, like the absolute most a business can produce.
Picking what they have to work with.
Right. From a given set of inputs,
Hmm?
labor, capital, like machines or ovens, land, the space they use,
And their current technology.
and their current tech, exactly. So for, let's say, a cookie bakery, it just tells us, with these bakers, these ovens, this tech, how many cookies can they realistically churn out?
Mhm.
Here's where it gets interesting, because our source actually has this great table for a cookie bakery example.
Yeah, I saw that. Very clear.
It shows how the number of cookies changes as you add more workers. And looking at that table brings up a really crucial concept, marginal product, or MP. This is a big one for the AP exam, definitely.
Absolutely.
It's the extra output you get when you add just one more unit of input.
Like one more baker.
Exactly. How many additional cookies did that new baker actually produce? And we figure it out by taking the change in total cookies and dividing it by the change in, well, the number of bakers.
Okay, let's walk through that cookie example. So 0 workers, 0 cookies. Obvious, right?
Right.
Then you hire your first baker. Boom, 10 cookies. So that first worker's marginal product, their MP, is 10.
Got it.
Now bring in a second worker. Total output jumps to 30 cookies.
Okay, so the second baker added 20 more cookies.
Exactly. Their MP is 20. Then add a third worker, and the total hits 54 cookies.
So the third worker added 24 cookies. Wow, they're getting more productive.
They are. That third worker added 24. What we're seeing here, from worker 1 to 3, that's increasing marginal returns.
Okay.
It's this crucial early stage where each new person actually adds more output than the last one.
Why does that happen, though?
Well, think about it. Specialization starts kicking in. One person mixes, one decorates maybe.
Teamwork.
Teamwork, better use of the ovens, They really boost the overall team productivity at this stage.
So if you're the business owner, this is fantastic, right? You're hiring more people, and each one is adding even more value than the last. Super efficient.
It's great. It's a clear signal. Yeah, keep hiring.
But there's always a but in economics, isn't there?
There usually is. There's a limit. And that brings us to this fundamental principle, something you absolutely will see on exams. The law of diminishing marginal returns.
Okay, the big one.
It is. The law basically says if you keep adding more and more of a variable input, like our bakers,
No.
to fixed inputs like the size of the bakery, the number of ovens, things that don't change quickly,
Right, those stay the same.
then the additional output, the marginal product you get from each new worker, will eventually start to fall. They might still add cookies, but just less than the person before them.
Ah, okay. So the returns start diminishing.
Precisely. Let's go back to the bakery example. Worker number 4 comes in. Total cookies reach 70.
Okay, so they added 16 cookies
Mm.
from 54 to 70.
Right. Only
Yeah.
16. Less than the 20 for the third worker added. This is the start of decreasing marginal returns. MP is falling, but it's still positive. You're still getting more cookies overall.
Still good, but not as good.
Exactly. Now, the fifth worker adds just 10 cookies, bringing the total to 80. MP drops again.
Okay.
And here's where it can get really tricky. The sixth worker joins, and total output actually drops to 72 cookies.
Wait, drops. How?
Uh-huh. Drops. That's a negative marginal product. -8 cookies, actually.
So adding a worker made things worse.
Yep. Too many cooks in the kitchen, literally. They're getting in each other's way, waiting for oven time, maybe causing spills. It's chaos.
Okay.
And distinguishing between decreasing returns where MP is falling, but positive and negative MP where total output actually falls, that's a common sticking point for students. So make sure that distinction is clear.
Got it.
What?
Decreasing is less good. Negative is actually bad for total output.
You got it.
Okay, so besides the marginal product, there's also average product, or AP.
Right.
This one seems simpler. It just tells us the average output per worker, right?
Exactly. Straightforward formula. Total product divided by the number of inputs. Total cookies divided by number of bakers.
So in our example, when we had 3 workers making 54 cookies.
Yep.
The average product is 54 divided by 3, 18 cookies per worker on average.
Perfect. That's AP. Now, let's try and visualize this. The relationships between total product, TP, marginal product, MP, and average product, AP, are really key. Think about them on a graph.
Okay.
That early phase, let's call it zone A, that's where you have increasing marginal returns. MP is rising, pulling AP up with it, and TP is increasing really fast.
The good times.
The good times. Then you hit zone B. This is where diminishing returns kick in. MP starts falling, but it's still positive.
Still adding cookies, just fewer.
Right. So TP is still increasing, but slower now. It starts to curve over, and MP will eventually cross AP here. And then zone C. This is where things go south. Negative marginal product, MP dips below the x-axis.
And total product starts falling. Too many bakers.
Exactly. Too many bakers. Now, these relationships, they're gold for exams. A couple of clues.
Okay, AP test clues.
Yeah. First, when total product hits its absolute peak, it's maximum. Marginal product is 0. MP crosses the x-axis right then.
Makes sense. The last baker added nothing, so you're at the top.
Precisely. Second clue, this MP-AP rule. When MP is above AP, it's pulling the average up, so AP is rising.
Okay.
When MP is below AP, it's dragging the average down, so AP is falling.
Like grades. A low test score pulls your average down.
Exactly like grades. It's the same principle. And the critical point, when MP equals AP, right where they intersect, that's when AP is at its maximum. AP peaks where MP crosses it.
Got it. That average relationship is super important.
It really is. Applies all over economics.
Okay, that's a great picture of the production side. But, every cookie, every worker, it costs money.
Always does.
So let's shift gears smoothly from how much we produce to how much it costs us. Let's talk marginal cost, MC.
The other side of the coin.
Exactly. This is the extra cost the business faces to produce just one more unit of output, one more cookie, in our case. And just like marginal product, there's a way to calculate it, right? Change in total cost divided by change in quantity.
Spot on. Change in total cost over change in quantity. And you called it the other side of the coin. It's often seen as the mirror twin of marginal product. They're inversely related.
How so?
Well, think back. When we had increasing marginal returns when workers were getting super productive.
Adding more and more cookies each.
Right. What happens to the cost of making one additional cookie?
It should go down because you're getting more efficient.
Exactly, it falls. So in that early phase, let's call it zone D on a cost graph, you have decreasing marginal cost. It gets cheaper to make the next unit because your inputs are working so well together.
Okay, that makes sense. High productivity, low marginal cost.
Then what happens when we hit the law of diminishing marginal returns?
Workers add less output. They're getting in each other's way.
So the cost of getting that next cookie...
It starts going up. It takes more effort, more time, more hassle for each extra cookie.
Precisely. That translates directly to increasing marginal costs in Zone E. As workers become less efficient, each additional unit costs more to produce. Understanding that link productivity driving costs is just fundamental.
Productivity up, marginal cost down. Productivity down, marginal cost up. Got it.
And just like MP and AP had that relationship.
Let me guess. MC has a relationship with average costs.
You got it.
Yeah.
Specifically with average variable cost, AVC. AVC, like AP, tends to fall, hit a minimum, then rise.
Okay.
And here's the test clue, that lowest point of AVC. It always happens where marginal cost crosses average variable cost. MC above AVC at the minimum of AVC.
Same logic as before. The marginal pulls the average.
Exactly the same logic. MC below AVC pulls it down. MC above ABC pulls it up. They meet at the bottom. Pause the screen for a moment and try the practice problems. The answers are at the end of the video.
Okay, now that we've got marginal cost, let's break down the different types of costs in the short run. First up, variable costs, VC.
The ones that change.
Right. They change directly with how much you produce. Like, Ingredients for our cookies. More cookies means more flour, more sugar, more chocolate chips.
Your electricity bill might go up too, running the ovens more.
Good point.
Mm-hmm.
Then there are fixed costs, FC.
The stubborn ones.
Yeah, the ones that don't change with output.
Yeah.
No matter if we bake 0 cookies or 1,000, these costs stay the same.
Like the rent for the bakery space.
Exactly. Rent, maybe the insurance, the cost of the big ovens themselves, perhaps, a business license fee.
Those are fixed, at least in the short run.
Right. And putting them together. Variable costs plus fixed costs equals total cost, TC.
Simple addition. VC plus FC equals TC. Now, if you graph these TC, TVC, total variable cost, and TFC, total fixed cost, you see some clear patterns.
Okay.
TFC, total fixed cost, is just a flat horizontal line, right? Cost is the same no matter the quantity.
Constant. Yep.
TVC, total variable cost, starts at 0, no output, no variable cost, and then slopes upward as you produce more.
Makes sense.
NTC, total cost, is basically the TVC curve just shifted upwards.
By how much?
By the amount of the total fixed cost. That vertical gap between the TC curve and the TVC curve.
Ah, that gap is the fixed cost.
It is the TFC, and that gap stays the same, perfectly constant, no matter how much you produce.
Which means TC and TVC lines are parallel.
Exactly, because TFC is constant. Here's a quick AP tip. Often, multiple choice questions just say total cost.
Yeah.
Always, like, mentally split that in your head. Okay, that's fixed cost plus variable cost. Just remembering that structure can help you avoid traps and see the answer more clearly sometimes.
Good tip. Don't just think TC, think FC plus VC.
Right.
Okay, next, average cost. Average total cost, ATC. This is just total cost divided by quantity.
Yep. TC divided by Q gives you the cost per unit, all costs included. Sort of the bottom line average cost for each cookie.
Helps the owner know if they're making money per cookie on average.
Critically important for that. And this brings us to maybe the most important graph in this whole area. The one showing MC, ATC, and AVC all together.
The famous U-shaped curves graph.
That's the one. Full of insights. The absolute key takeaway, and you will be tested on this.
Okay, listening.
Marginal cost intersects both AVC and ATC at their absolute minimum points.
Both minimums. Why again?
It's that marginal average relationship. As long as the cost of making the next unit, MC, is lower than the current average cost, either AVC or ATC, it's pulling that average down.
Okay.
But the moment MC rises above the average, it starts pulling the average up. So the only place they can be equal is where the average stops falling and hasn't started rising yet its lowest point.
The bottom of the U.
The bottom of the U. It's not just lines on a graph. It tells a business owner exactly when per unit costs are lowest. Super practical.
Makes sense. And ADC is always above AVC, right?
Always. Because ATC includes average fixed cost, AFC equals TFCQ, and AVC doesn't. The gap between ATC and AVC is the AFC.
And that gap gets smaller as you produce more because you're spreading the fixed cost over more units.
Precisely. AFC always declines as output increases. So, just recap the relationships. When MC is below AVC and ATC, both averages are falling.
Okay.
After MC cuts through their minimum points, MC is now above them, so both ATC and AVC start rising. These relationships are crucial for the exam.
Definitely seems like a graph to know inside and out.
Absolutely.
So we've got the curves mapped out, but what makes them actually move, like shift on the graph? This section on shifting cost curves seems really important. You mentioned it's common on exams.
Very common,
Yeah.
because it connects these theoretical curves to real-world events. Let's start with changes in variable costs.
Okay, like our ingredients.
Exactly. Things that increase as output increases. So what if variable costs change? Say, the price of flour skyrockets. What happens to our curves? Well, marginal cost, MC, will shift up. It costs more to make each additional cookie now.
Okay, MC shifts up.
Average variable cost, AVC, will also shift up because the average cost of those variable inputs is higher.
Makes sense.
And because variable cost is part of total cost, average total cost, ATC, also shifts up.
So MC, AVC, ATC all shift up if variable costs rise.
Correct. But here's the key distinction. What about average fixed cost, AFC?
Fixed costs didn't change, so AFC stays the same.
Exactly. Your rent didn't change just because flour got expensive, so AFC is unaffected.
Okay, that's important.
A classic AP example for this is a per unit tax or an excise tax, like a tax on every cookie sold.
Ah, so it makes each unit more expensive to produce.
Right. So it acts just like an increase in variable costs, shifts MC, AVC, and ATC up, but leaves AFC alone.
Got it. Now, what about the other side? What if our fixed costs change, like our bakery rent suddenly goes way up?
great question, and the impact is different. If fixed costs increase higher rent, maybe a new annual license fee the government imposes,
Right.
then obviously average fixed cost, AFC, shifts up because
Right.
TFC went up.
Right.
And since fixed cost is part of total cost, average total cost, ATC, also shifts up.
Okay, so AFC and ATC shift up. What about the others?
Here's the kicker. This is crucial. Marginal cost, MC, and average variable cost, ABC, do not change when fixed costs change.
Wait, why not?
Because fixed costs, by definition, don't affect the cost of producing one more unit, that's MC. And they don't affect the variable cost per unit, that's AVC. Your rent going up doesn't change the cost of the flour for the next cookie.
Okay. That's a really important difference in impact.
It really is. A common AP example here is a lump sum tax. This is just a fixed fee the government charges a business, regardless of output.
Like a one-time business registration fee.
Exactly. It increases total fixed costs, so it shifts AFC and ATC up. But because it's not tied to each unit produced, it leaves MC and AVC completely unchanged. Knowing which curves shift with which type of cost change is key.
Definitely. Variable costs hit MC, AVC, ATC. Fixed costs only hit AFC and ATC.
You've got it. Pause the screen for a moment and try the practice problems. The answers are at the end of the video.
Okay, so far we've mostly been in the short run, where at least one input, like the bakery size, is fixed. But what happens when firms have enough time to change everything?
Now we're talking about the long run.
The long haul.
Exactly. In the long run, all inputs are variable. There are no fixed costs anymore, technically. The firm has enough time to adjust its entire scale, build a bigger factory, get more ovens, lease more space, change everything.
Total flexibility.
Total flexibility. And this leads us to the long-run average total costs LRATC curve.
Okay, what does that look like?
It's usually drawn as this broad, shallow U-shape. It's essentially made up of all the possible short-run ATC curves for different plant sizes. The LRATC shows the lowest possible average cost for producing any given level of output when the firm can choose its optimal size.
Okay, and you mentioned 3 areas on it.
Yes, 3 distinct areas, and these concepts are tested frequently. First, the downward sloping part, economies of scale.
Economies meaning getting cheaper.
Yep, as the firm increases its output and gets bigger in the long run, its average cost per unit decreases. This is also called increasing returns to scale.
Why does being bigger make it cheaper per unit?
Several reasons. Greater specialization workers get really good at one task. Bulk discounts on buying raw materials. More efficient use of large, specialized machinery that only big firms can afford. Think assembly lines.
Okay, economies of scale is the good part of getting bigger.
Generally, yes. Then there's often a flat part in the middle, constant returns to scale.
Meaning cost per unit stays the same.
Exactly. Doubling your inputs exactly doubles your output, so the average cost per unit stays constant. You're not getting more efficient by scaling up here, but you're not getting less efficient either.
Okay.
And finally, the upward sloping part, diseconomies of scale.
Diseconomies, so getting more expensive per unit now.
Right. As the firm gets too big, LRATC starts to increase. Average cost per unit rises as output increases. This is also called decreasing returns to scale.
Why would getting bigger eventually make things more expensive per unit?
It often comes down to management difficulties. Coordinating a huge workforce, communication breakdowns, too much bureaucracy, maybe layers of management slowing things down. It just becomes harder to run efficiently when you're massive.
Like trying to steer a giant cruise ship versus a speedboat.
That's a good analogy. It becomes unwieldy. And a quick AP tip here. If you see any question on the exam talking about scale, increasing, decreasing, constant returns to scale, ding, 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 they're almost certainly asking about the long run.
Got it. Scale questions, long run.
Usually a safe bet.
Okay, one final major topic. How economists measure success. Which apparently is different from how accountants do it. We need to break down accounting profit versus economic profit.
Yes, a crucial distinction, especially for understanding why firms make the decisions they do. Let's start with accounting profit.
The one most people know.
The one most people know. It's what shows up on the books, what you report for taxes, simple formula, total revenue minus explicit costs.
And explicit costs are?
The actual out-of-pocket payments. Money physically leaving the business. Wages for workers. Rent payment. Cost of flour and sugar. Electricity bill. Things you write checks for or see on a bank statement.
Tangible costs.
Tangible monetary costs. So, If our bakery brings in $100,000 in revenue and pays out $70,000 in wages, rent, ingredients, etc.
Accounting profit is $30,000.
Exactly. $30,000, that's what the accountant calculates.
But economists, they're never satisfied, are they? They dig deeper.
We like to consider all the costs, not just the ones where money changes hands. So economic profit takes it further. It's total revenue minus both explicit costs and implicit costs.
The implicit costs. Okay, what are those?
These are the opportunity costs. It's the value of the resources the owner uses in the business, measured by what those resources could have earned in their next best alternative use.
Like the salary the owner could be earning elsewhere.
Exactly. That's a big one. If the owner quit a $40,000-year job to start the bakery, that $40,000 is an implicit cost of running the bakery. Or maybe they invested their own savings. The interest they could have earned on that money is also an implicit cost.
Ah, it's the cost of the opportunity you gave up.
Precisely. So back to our example. $100 K revenue, $70 explicit costs gave $30 accounting profit.
Right.
Now, let's say the owner gave up that $40,000 salary. To find economic profit, we take the $30,000 accounting profit and subtract the $40,000 implicit cost.
Which gives negative $10,000.
Negative $10,000 economic profit.
Wow. So they made an accounting profit, but an economic loss.
Exactly. And this highlights the key differences. Accounting profit is usually positive unless the business is really struggling. Economic profit is often much lower, frequently zero or even negative.
What does zero economic profit mean? Is that bad?
Not necessarily. Zero economic profit is called normal profit. It means your total revenue is exactly equal to your total cost, including all those implicit opportunity costs.
So you're covering everything, including what you could have earned elsewhere.
Yes, it means you're doing just as well in this business as you would in your next best alternative. Your resources are earning their keep, basically. It's sustainable. It's not a sad situation. It means this is a perfectly viable use of your resources.
Okay, normal profit, breaking even economically.
Right. But a negative economic profit, like our negative $10,000 example, that's a signal.
A signal to do what?
A signal that your resources, your time, your money could be generating more value somewhere else. It's an economic incentive to potentially close this business and go back to that $40,000 job or find a better use for your capital.
So who uses which profit?
Well, accountants, the IRS, shareholders looking at financial reports, they focus on accounting profit. But economists and really smart business owners making strategic decisions about whether to stay in an industry or how to allocate resources, they focus on economic profit. It gives the truer picture of overall performance relative to alternatives.
That makes a lot of sense. Accounting profit is about the books. Economic profit is about the real choice and opportunity.
You nailed it.
Wow. Okay.
Pause the screen for a moment and try the practice problems. The answers are at the end of the video. This is the last chapter. Check the answers to the practice problems you solved in the video. Got it, everyone. Hope you followed along with today's lecture. Now, let's break down those quiz answers and make sure everything we covered really sticks. You can grab the complete mind map Musica. It's a killer snapshot of today's lesson, plus a super detailed AP economics textbook at www.aplusmap.ai. Ready? Let's get into those quiz answers.
We have covered a ton of ground there, from how many cookies one baker adds, all the way to long-run decisions about factory size, and even digging into what profit really means to an economist.
We really did. We saw how things like diminishing returns aren't just abstract ideas, they directly drive costs.
Yeah.
And those relationships between MC and ATC-AVC, the difference between short-run shifts and long-run scale decisions, these are practical tools. Hopefully, everyone listening feels much more prepped for those AP questions now.
Yeah, definitely feeling more confident about those curves.
Yeah.
So tying it all together for you listening, what does this mean? Well, next time you read about a company expanding or maybe laying off workers or you hear about a new tax, they'll have this deeper toolkit, right?
Yeah.
You can think about, okay, how does this affect their fixed costs, their variable costs, their marginal costs? Is this a short-run adjustment or a long-run scale change?
Exactly. You can analyze the underlying economics driving those real-world business headlines, which actually brings up a good final thought for you to chew on. Thinking about our cookie bakery again. Imagine a huge technological breakthrough, a revolutionary new oven that bakes cookies twice as fast using half the energy. How might that kind of innovation impact all the different cost curves we talked about today? MC, AVC, ATC, AFC, both in the short run, and potentially the LRATC curve in the long run.
Ooh, that's a good one. A tech shock changing the cost structure. Lots to think about there.
Definitely something to ponder.
Well, thanks for diving deep with us into the world of production costs today. Keep that economic curiosity burning.
We hope you're excited for what's next. For more learning materials, please visit aplusmap.ai.